Good morning, everybody. Welcome to the game plan. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. As you can see, I am on vacation this week. So, again, lighting may be a little bit wacky, but nonetheless, I'm going to bring you the same quality information. No BS, just charts. All right. So, what we saw last week was a pretty pivotal decline on Friday. Now, this coming after the non farm payrolls report came in weaker than expected, and the previous 2 months were revised dramatically lower. Obviously, the president wasn't too happy with this, which I think added fuel to the sell off on Friday. However, this morning, we are seeing the markets try to buy the dip. Investors are out there. They're thinking this is a great opportunity. We're going to take a look at the charts and find out. So let's jump into the charts here as we take a look. This is the S&P futures chart. And what we can see is that, again, overnight, this is where we opened at 6 p.m. on Sunday, 6 p.m. Eastern time. And you can see that the markets kind of ground higher all night long. Now, we're not up huge, but we are up solidly, getting back about half of the loss from Friday thus far. So let's keep an eye on that. Let's see where things go. If you go to last week here on Friday, this again was when the non-farm payrolls report came out, and you could see the rollover and sell off on Friday that we saw. One of the bigger down days we've seen in quite a while in the markets. Now, if you've been paying attention to the game plans, I've kind of walked you through why something like this was inevitable. Now, again, we didn't know which day it was going to come out. Was it going to be on the Fed decision on Wednesday last week, the jobs report, the PCE on Thursday? Where were we going to see it? But ultimately, the charts, as I described, the S&P was hanging off of a cliff. And again, I'll take a show where I'll show you guys exactly what I mean by that. So let's flip over to the S&P itself so we can look at the daily chart. So this was probably the most amazing thing that I discovered last week with you guys. This is a parallel channel. And again, parallel channels have more and more meaning to me in technical analysis. It's something that not a lot of people have discovered. People can draw trend lines. They don't usually do it great. But again, my hope is that I can guide you. But the parallels are the ones that are more powerful because the lines are parallel. And that means there's more credence to them. And what we could see here on the S&P is that the low from October 2023, after this nice long downtrend here, that low matched up perfectly with the April 7th low, gave us this parallel line that matches up with the highs from 2024 and gave us the gap up high on Thursday when Meta and Microsoft reported blockbuster earnings. And notice again how we saw that sell-off. And just recall, last week we talked about how the selling was starting to come in from the institutional base. Why? Well, because you had a gap up on Monday and a sell-off to the flat line. Gap up Tuesday, a negative day. Gap up Wednesday, negative day. Gap up Thursday. This is all signals of institutional unloading. So those were some of the short-term factors. One other one where I talked about us being kind of hanging off a cliff was from this trend line right here. We slope it up, connect it to the lowest point from April 7th to the secondary lowest point here. Notice no candle on the chart touches this line until right here. We broke below it, and then we kind of bobbed slowly grinding higher until the latest fall. And look at how in 2 days, the gap up on Thursday reversal and Friday down move, we literally took out everything all the way back to where this trend line was broken. And that's why I said we were hanging off a cliff, because even though we were hanging off a cliff, we were still hanging, meaning that one hand was still holding onto the cliff. We weren't going over the cliff. And that shows us how we were kind of grinding very slowly. But this is where you fall, right? We always talk about how the markets take the stairs up and the elevator down. And sure enough, you can see the elevator right here, wiping out literally 2 to 3 weeks of upside in the market in just 2 days. Now, another thing I want to show you guys is this chart here. And this is a chart. I'm going to get rid of these trend lines. We're going to flip it over to the logarithmic scale. And this is something I showed you months ago. And it was something that had me very concerned about the overall market. Take the high going back to 1929, just before the Great Depression and the stock market crash. Connect it right through that secondary high right here in 2000, the dot-com bubble high. And if we drag it up here, look at what we get right there on the chart. So again, right into this level here on a trend line that literally spans almost 100 years in the making. And what that tells me, by the way, I mean, if you just look back here, we saw, you had the, dot-com drop. That was a big drop. And so who are we to think that we're not supposed to pull back off this? Now, listen, do I think it's going to be like a .com situation or a 1929? No, I mean, I have no idea about that. That's long-term projections. But in the short term, as a swing trader, and remember, I'm a swing trader, so I don't really focus on where the markets are going to be in 5 years from now or 3 years from now. Heck, I don't even know where the markets are going to be in 1 year from now. What I do know is that when you hit key trend lines, you tend to have an immediate reaction. If it's a support line, you're going to get a bounce. If it's a resistance line, you'll get a pullback. And that's how I trade. That's what a swing trader does. And just on a smaller time frame, that's what a day trader does as well. All right. So again, just want you guys kind of fully immersed in the understanding of this. So again, we'll watch and see where things go here on the S&P, but certainly a nice pullback on that weekly chart from last week. Now, flipping over to the US dollar, this was something I discovered just over the weekend here. And look at this. We're in this little parallel channel on the DXY. Now, the DXY, remember, is the dollar against a basket of currencies. So it's how is the dollar handling everything versus, the yen, the euro, the pound, etc. And we've been in a pretty dramatic downtrend. Again, ever since we go back to 2025 January, it's been pretty steep in terms of the decline. Now, the decline is getting a little bit more kind of flat. And what we can see is we've established a parallel here where every time we get to the bottom of this parallel, notice you get a bounce up and a bounce up and eventually find your way to the top of the parallel. So again, the idea was as we come into this high here, which was just above 100 on the DXY, the idea is we should get a pullback. Now, again, will we eventually go to the lower dimension of this parallel? The answer is probably eventually. We don't know how it'll get there. You can see here to get to the top, we had to have this little pullback right there. But the idea is this gives us a very firm basis for resistance on the dollar if we tag this and support on the dollar down here. The 10-year yield took a massive decline on Friday. It is continuing to downtick a little bit today. The 10-year yield near 4.2%. And this obviously with the weaker jobs number, we went from Wednesday after the Fed not expecting a rate cut per the Fed watch tool to now a rate cut in September is back on the table. All right. So again, downward break here of a wedge pattern. Wedges, again, remember they're coiled springs getting tighter and tighter and tighter. And therefore, when you break, it tends to be a big move. And I think we can all agree that the break on the 10-year yield on Friday was a pretty big move. I don't think it's done yet, by the way. I do think you will get a bounce. Potentially what we see in these situations from a technical analysis perspective is a retrace to the scene of the crime and then a continuation to the downside. So again, overall, the bias remains negative on the 10-year yield, but you just have to potentially expect a retrace to the scene of the crime, which again would be the breakdown trend line right here. That's what's called the scene of the crime. All right, so 10-year yield, the dollar, we've seen some good downside movements, obviously on the back of the economic data. And I think it's important to kind of understand really what's going on here. So Wednesday, we heard from the Federal Reserve, and they were very kind of cautious, almost hawkish on cutting rates. And the market didn't like that one bit. Then Thursday, we got the PCE data. Year over year was higher than expected. We're starting to see an uptick in inflation, whether it be the tariffs or whether it be other factors, we don't know. But ultimately, what we do know is the data is showing inflation is starting to slowly creep up. By the way, not nearly back to that 9% we saw a few years ago, but it's just about the trajectory. Is it starting to uptick just a little bit? And then obviously on Friday, we saw the jobs data and the revisions point to a much weaker labor market than anyone had necessarily expected. Now, the key here is when you have upticks in inflation, but a labor market that is starting to come down, what does that mean? It means potential stagflation. And I'm again going to bring that up to you guys. Remember that term. That is not a good term net for the overall markets. All right. Very, very bad to have a rising inflation with a weaker market or a weaker economy. All right. Let's take a look at Tesla. Tesla approving a $29 billion pay package for Elon Musk. And again, you can see the stock is up. Now, a pay package of $29 billion is generally a hefty kind of dilutionary factor for investors. So it dilutes shareholders. Obviously, if he's getting granted a bunch of shares or compensation, it dilutes shareholders. But the reason why the stock is up this morning at 310, it's not a huge move, but it is up, is because the hope is this gets Elon Musk to focus back on Tesla, right? So again, it's all about can Elon, and listen, regardless of what you feel about him, he knows his stuff. He knows his stuff. He's obviously built up Tesla pretty well, and he has these other companies as well. And so the idea is the reason that why the board of directors and they wanted to give him this pay package is because the hope is that he refocuses now on Tesla and will actually make it improve. And I think that's why you're seeing investors happy, because it's all about making Elon Musk happy when it comes to Tesla. All right. Now, again, what kind of pattern is this? We just saw it when we looked at the 10-year yield. This is a wedge pattern. Wedge patterns, again, you can see the bigger move here, smaller, 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 right? So it's a compressing spring. The question is, which direction does it break out? Today's gap up is only a minor move up. It is not going to break us out. And the question then is, in the coming weeks and months, which way do we break? Whichever way we break, just be warned, it is likely to be a big move in that direction. Spotify this morning is gapping up. This is the pre-market action in Spotify. It's not a huge gap, but I wanted to bring it to your attention because the announcement from Spotify is that they are raising prices. The market likes that because they feel that they do have pricing power. I would just say that, again, once companies start to struggle gaining subscribers, oftentimes they turn to raising prices. We've seen this with Netflix. And by the way, just bringing up Netflix has really come in substantially from the recent highs here. And look at this. And again, beautiful upsloping trend line on Netflix. But look at the pullback that it's seen. Second target down here. We already hit my first target. I raced it. But second target is 1105 here, which should be subsequent support. And again, remember, and this is so interesting on Netflix, is Netflix, I believe it was last quarter, was the last quarter that they reported subscriber numbers. They said prior to that they would no longer report subscriber numbers. Why not? That tells us something, right? And then all of a sudden we see Netflix starting to come down here and starting to fade after the recent earnings report. And obviously, it was even fading prior. But I think that lack of transparency makes investors nervous. And it also shows that they're not confident in their subscriber growth. But what has Netflix done almost every quarter or every year in the last few years? They've been raising prices. So raising prices. And again, you could also throw this out there. Spotify, Netflix, a lot of these services are now raising prices, which again, on some level is no doubt inflationary. Rising prices is inflationary. All right. Now back to Spotify just quickly. If we look at the daily chart here, it was just into technical support. Look at this nice support area here. This was one that I had in smart money stocks and ETFs as a short. We were short from up in this upper range here, and we did cover it last week, taking profits of about 10%. And again, good to see that bounce up. I could potentially look to re-short Spotify as a swing trade, but it would be right in this range here. All right. Right around 705 to basically 700 to 705. Gap fill right here. Again, for those of you that are newbies, learn what gap fills are. Those are where price closed this day, but then gapped down on this day, right? So that creates a gap in price. All right. And then you also have this low pivot right here, this base level here, right, all the way through here, and then the breakdown occurred. And so that tells me there's a lot of technical resistance. So while you're seeing a reaction in Spotify shares right now, keep in mind that if it rallies up enough, this does become a good swing trade short. Tyson Foods reported earnings this morning. We flip over to the 10-minute chart. You can see a little bit of a pop there. Interestingly enough, look at where this stock was trading here. In the longer scheme of things, it was kind of beaten down. So obviously the bar for earnings was a little bit lower, and it is opening higher. It's not a big enough move for me. It's only about $2. So on a $2 on a $55 stock, very small percentage wise. So for me, again, there's no trade on this. It would really honestly have to go all the way up to 57.70 or so. And then maybe with this area here and this pivot high right in here, that would give me an opportunity to day trade it as a short. I don't see a swing trade level on this at this point. Wayfair reported earnings pre-market. You can see it's had a nice little move here. There is resistance on Wayfair. If we zoom out on the chart, there's resistance, a minor level at around 76.35. Let me put a trend line in there for you home gamers here. So again, right in this range right there, that pivot high. And then just above it, there's another peak right in here that could give us an opportunity. I think there's a secondary level right here at around 78.50. All right. So again, I don't know if for me as a day trader, if I'd feel gutsy enough to short 76.35, because again, pre-market, if we look at it, it kind of already almost got there, got to about almost $75. But certainly if it continued to squeeze to the upside, the 78.50 does look very attractive. Now, after the bell today, we have some big earnings. Palantir has earnings here, and this stock again has been in a short-term parallel, just tagging the upper end. Upside in this case would be somewhat limited because again, you have $63.25. That gives us about, from current levels pre-market, it is gapping up pre-market, by the way, to 57.66. But again, that only gives us about $6 of upside on earnings. Downside to first support would be 142. So from current levels, that's about $15 to the downside. The other thing to keep in mind is Palantir remains extremely extended. The growth should be fantastic. I fully expect them to beat their earnings. But remember, folks, when a company beats on earnings, it doesn't mean the stock goes up. And we've seen this with a lot of stocks this earnings season. It depends on how much the stock has rallied up into those earnings. Because again, the higher it goes into earnings, the better the results have to be. So a beat is just not enough at this point on some stocks to really justify even a more upside action. And it's important to understand that, because I think people look at earnings as very one-dimensional. As in like, oh, they beat on revenue and they beat on earnings. Okay, the stock should go up. Not always. And always remember this, guys. These are really important things. Look at the chart first. If a stock has rallied 100, 200% going into earnings, that bar is probably so high that it literally almost anything they report will not be able to justify or dissuade the profit taking after that report, because the bar is so high. So again, going into earnings in general, I would expect a pullback. Maybe it pops first. I think initially sometimes these big prints, the algorithms and retail really buy those earnings out of the gate, and then all of a sudden the institutional sellers come out of the woodwork. Bitcoin, 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 guys. All right, you can see I've got a ton of annotations here for you. We did hit first support. I talked about this general vicinity last week. And again, notice where this first support, the low over the weekend on Bitcoin, was this previous high. All right. So that, again, you're getting a little bit of a bounce. A lot of people out there in the technical analysis world called this a bull flag. I accurately kind of corrected them in these game plans and said, nope, the topping tail, which is a bearish reversal signal, it's bearish consolidation off that. Therefore, bear flag, not a bull flag. And that was the correct call. All right. Now it's come down beautifully in Smart Money Crypto. I was overly excited to be able to cover a lot of our short-term shorts on a lot of these altcoins out there. We made a lot of money. Pudgy Penguins, 28% gain just on one of those right there. But the key here is understanding that you're now getting a little bounce. What could end up happening here, we may end up going back to what we would call a retrace to the scene of the crime, the underbelly of the bear flag. And then you would expect probably your next move to the downside. Now, what would change my mind? If you could fight inside of the bear flag again and start to consolidate, you could reestablish, and any sort of break above this 120,000 level would then, in my opinion, at least test the high of the topping tail, potentially catapulting it to the upside. But again, just pure charts, no BS. The answer is, okay, you got it. You got this little pivot point at 11,800 to kiss. Now you're bouncing, but you have to respect the 117,000 level, which is the underbelly of that bear flag, as key resistance. All right, let's go on to gold today, see where gold is trading. Gold continues to move up. Look at what gold is doing. Now, remember, we just were looking at a bear flag that broke down. This would be a wedge pattern that broke down. What do both of them have in common? They're both retracing to potentially the scene of the crime. So again, same thing, broke a major trend line that goes all the way back to December of 2024. We broke it, we confirmed it, we continued. Then you're getting the bounce. Resistance is going to be just above 3,400 on gold. Now, if it can somehow get above like 3,420 and confirm, now the bear case goes away and the upside continues. But right now, if you're talking path of least resistance, it's to bounce and pull back off of that key wedge pattern. And remember, folks, I am in a world of probabilities. All right. It doesn't matter what my personal beliefs are. It doesn't matter what my gut tells me. those are almost always wrong when it comes to investing. And I think we've all experienced that type of impact. It's all about the charts. That's the only way that I'm a good trader and investor, is because I follow the charts. And essentially, I look at the charts as being a foreign text, right? And so my job to you guys, and I hope I can teach you the language here, is to translate this into words that we all understand and talk about resistance and support and give you guys the playbook of what the foreign text says. That's what a chart is. It's just telling us in a different language what is most likely to happen. All right. Going back to the charts here, let's jump over to silver. Silver was another beauty that pulled back off a longer term trend line right here. You can see every time it hit going back to 2022, it pulled back. Notice again, if we talk about where it came into, you have kind of this zone here, right? You had all of this consolidation. It comes down there and it is holding that. Now it's not a buy yet for me, because again, I don't know if this is going to make a bear flag off of this down move, right? So again, if we were to see this, and let's say we start to go like this would be a bear flag. I still like the 3465 level as major technical support, because it's a this would be a retrace to the scene of the crime, but on a breakout versus what we've looked at before, which was breakdowns. High pivot, and high pivot, small pullback, breakout. So if you come back into this level, there should be a ton of support at around 3465. Now, it may not. It could just go up and make new highs. And you know what? I'm more than okay with that, because as a trader, I miss hundreds of trades every day. All that matters is that a few come and hit my levels and I get them. That's it. Just a few. I don't need 100 a day. I need like 2, 3 max, and I can make incredible money. And I want you guys to have that understanding, right? Where it's all about discipline, which keeps you safe from taking bad trades. Naturally, we all have a bad trade here and there. That's just the nature, because probability means it's not 100%. But it's the idea of being as disciplined as you can and taking only the trades, let's say, that are 75% success rate trades. And then that ultimately will, over the longer term, that win rate will take you to the promised land, or as I call it, the profit land. All right. Quickly going through a few of these other charts here. Let's take a look at oil. Oil, guys, it is continuing to break down. I did short oil with members of Smart Money Commodities right here, and we are nicely in the money. I did hear OPEC raised production again. They're really trying to kind of stifle out U.S. producers by dumping a ton of oil and keeping prices to the downside. Add in a weaker U.S. economy, and obviously oil should continue down. Now, again, at some point, I'm going to take half off my short here on oil, because frankly, at some point, you just want to play it safe and just kind of pocket some money and put a break-even mental stop in. But nonetheless, great move down. I would continue. You're going to have a little bit of support right here. Okay. So right here at around 65. But if we break 65, we should be headed towards 60 on oil. And then lastly, natural gas here real quick. Taking a look. Again, we talked about how we hit this trend line. We got a small bounce. But usually what ends up happening here, guys, is you get small bounces on the fourth hit. And then the fifth hit, it favors a breakdown. And that's why I didn't buy this hit. Even though it was a beautiful hit of this trend line and you got a small bounce, you can see already today it is trading lower. And the question is, when does it break to the downside? Inevitably, you could almost even make a case for a head and shoulders here, right? So you have a shoulder, head, and shoulder. And if that's the case, I mean, what's kind of crazy about this is that the measured move of this would be an incredible drop in nat gas. I mean, it's almost hard to believe that nat gas would go this low. But just to point out, let's just say it does. Where does nat gas target? Basically down to $1. If now, again, listen, it doesn't mean that every head and shoulders has to play out to target. Some don't, and this one may not. But wouldn't that be interesting if nat gas went down to basically $1, give or take? I mean, where's the U.S. economy at that point if that were to happen? So, anyways. All right, guys. Listen, I am on vacation. I appreciate you guys coming out as always to support us here at Verified Investing. I really do try to bring my A game even when I'm on vacation here. But again, the key is just charts, which give us probability. And from probability, we can then take it into trading opportunity. And that can lead us to profits. And so always remember, it's not what our guts, our minds, our feelings, our hearts tell us. Those are great things in human nature to have. In trading, they will make you lose money. And not only that, the institutions know. They know exactly the buttons to press to make you and every other investor out there overreact and act emotionally, to FOMO in at the highs, to FUD at the lows and panic and dump at the lows. They know it and they'll press your buttons. So our only option is to keep that emotion bottled up when we're trading and investing and go to the charts. That's my humble opinion. All right, guys, go have a great rest of your day. Thanks so much for coming out. I appreciate each and every one of you, and I'll see you soon. Take